So what do you do with all this stuff? We've just gone through these 4 different operating accounts. We went through and talked about payables, deferred revenue, receivables, and prepaids. So what do you do with this? Well, what we're thinking is we don't really care about each of the individual items. We're really worried about what is happening with the net change in these accounts, whether it's a payable, deferred revenue, receivable, or prepaid. What's the net change? And so the way we want to think about this is we're always going to start when we look at looking at a cash flow statement. We're always going to start with some kind of a proxy, right? So when we're looking at operating cash flows, we're always going to start with some kind of a proxy. And the proxy we always start with, using the indirect method or even the reconciliation of net income to operating cash flows, is the starting proxy is going to be net income. So let's write down, we're dealing with operating cash flows. And we want to put in our starting proxy, our estimate. Because net income is a pretty good starting point for estimating cash flows, operating cash flows specifically. So we need to start with a starting proxy. Estimate for operating cash flows. And that number is always net income or loss. So we're always starting with this. And then what we're doing is we are adjusting what we see in net income or loss to get to, from this estimate of operating cash flows, the proxy, net income or loss, to what we believe to be a reasonable estimate for operating cash flows. So these operating accounts that we have, payables, deferred revenue, receivables, and prepaids, we can break those down into 2 different categories: operating liabilities and operating assets. So anything that's on the liability side, that's part of an operating account that goes through the different processes and you have residual liabilities coming off of that, is an operating liability or an operating asset. Okay. And the basic examples we've already pointed out. We're looking at payables or deferred revenue. And here we're looking at receivables or prepaids, right? Those are your basic 4 categories of operating liabilities and operating assets. So I'm a big fan of creating 2x2 schematics. And sometimes 2x3s. So when I look at the net change in an operating liability or operating asset, those net changes are going to have an influence on my proxy for cash flows, right? And my proxy for cash flows, again, is net income or loss. So I'm looking at net changes. So when we have net changes, of either operating assets or operating liabilities, there needs to be a adjustment to the proxy. So let's say for a moment that we've got increases and we've got decreases. Again, these are net changes to these operating liabilities or operating assets. So in these boxes, what I want to do is figure out, well, if I have an increase in an operating liability, how do I change my proxy? How do I alter net income because of that? Well, let's look at the payable as an example. So if we have a net increase in this payable, what's happening? Well, I have more expense, or I purchased more inventory than I've paid my vendors. And so the assumption is that all of that increase is going into expense, and it's going into the income statement. But I haven't paid cash for that increase in the payable. But in net income, in my proxy, there's a higher expense here that's not related to cash. So think about this. Think about this as wages payable and paying employees. If the wages payable number goes up last year over this year, that means I had more expense than I actually paid employees. That net expense, net increase in expense, is sitting in net income. Remember, this is accrual net income. I want to get cash, operating cash. So this has more wages payable, more whatever the expense is related to payable in here. So when this balance increases, I want to decrease, because I have actually, I want to not decrease. I want to increase my proxy. Right? We can see that there's a positive sign here. Well, it's blank, but I want to increase my proxy because my proxy, my income statement, has been reduced by this expense. So I want to increase. If the net change goes down, that means I paid more employees, paid more vendors than I incurred in expense. Well, I need to capture that change in cash. So when it decreases, I need to decrease the proxy because it should be a negative accounts payable. That's going to have a negative effect on cash. So going over to our little 2x2, when I have increases in operating liabilities, I need to increase the proxy. Again, the proxy is net income. If I have decreases in operating liabilities, I need to decrease the proxy. Again, the proxy is net income. You can imagine, given our understanding of the signs here, that when I have changes in my operating assets, I should have completely the opposite result. So let's write it in, and then let's look at receivables and see if that proves out. So when I have increases in my operating asset, my net operating asset accounts, I want to decrease the proxy. Again, the proxy is net income. And if I have decreases in the operating asset, I want to increase my proxy. Again, my proxy is net income. All right, so let's try it. Let's take a look at one of these operating accounts. Let's look at receivables specifically. right? And let's ignore for the moment that we've got the allowance in there, okay? So if receivables goes up, what does that mean? Well, it means I have more sales on account than I have cash collections. Let's assume we don't have bad debt expense. We'll just look at cash collected and sales on account. I have more sales. So in my income statement, in my proxy, I have a higher amount of sales in here that's not related to cash. Net income is higher for these sales, net sales over the cash amount that I collected. That sales amount is higher here, and that's not related to cash. So I need to reduce that net income to represent what I actually got in cash. Well, let's look at it the other way. What happens if net receivables goes down? Well, that means I have collected more cash than I have sales. So here in the income statement, that additional collection of cash is not represented. So I need to, when receivables goes down or whenever any operating asset goes down, I need to increase the proxy. So this little 2x2, strong recommendation to have this handy when you do the cash flow assignment. Because when you're looking at operating, first of all, you got to figure out what's an operating asset, operating liability, and then you use this to say, okay, well, if I look at last year versus this year, the operating liability is increasing. That means I know I have to make an adjustment to the net income in the indirect method to get from accrual net income to operating cash flows. And we'll show you exactly in another video how this all comes together.